Hello traders, welcome everybody to today's webinar. So we are transitioning into the start of today's daily webinar on the markets and going through the economic calendar and taking a look at fundamental factors that will be affecting our trades for the day. Now, I would like to start today with a quick preview of sound and video. Can everybody see me and hear me well? Please write in chat. I'm going to have a glance at our commentary right now. So I can see some people writing in chat. If you guys can give me a nice hello and a thumbs up or a plus that you hear me and that you can see me, and we'll start the webinar. Wonderful. Thank you guys so much for writing that. So now that we know that sound is good, let's have an overview of the market about what's been happening the last week, last month maybe. So here we have the S&P 500. We can see that there's really this nice area that we have returned to, which provides no clear entry points for us. It's a very important point for interest, and it shows no clear follow-through. So here, this area that we're doing business in, there's no clear trade signal for us to trade this instrument right now. Volatility by itself is really not a good reason to be in a trade, and even from this point we can see that we have hit a resistance point. Now, one of the clear factors that we have also affecting the stock market right now is the government shutdown from the United States. They're on their 26th day of shutdown, and that carries a lot of economic consequences for us as traders. Now, the impact loss per week that the government is shut down is around 0.13 of the yearly GDP. That's right. So in a week, that would be around 0.5% of the GDP to just be cut off. Those are huge numbers, and we're on week 4 of this government shutdown. Last year's performance, just so that you know, overall in the US was 2.2% growth of the GDP over the year. Also on top of that, we're adding pressures from the trade wars. I'm going to check in real quick if we have any comments. So I'll be doing 15-minute stops. I'll speak for about 15 minutes and then return to commentary so that I can answer all of your questions. We'll have Q&A at the end of the webinar. So trade wars is also adding a lot of tension, and we can see that this kind of buildup leads to some effects on the bond market. Now right now this is a graph of the US 10-year bond yield. You can see that if you buy US Treasury bonds, you'll get a 2.7 return on investment year over year. Now this is an indicator of the US credit risk. So the more people buy these bonds, the more the US has a higher credit rating basically with the whole world. Now, currently, they're at a risk of being downgraded. The last downgrade we had, let's take a look at the graph, was in 2011 by Standard & Poor's. Now, the effect continued all year long. If we look way back in our graph, this is a daily time frame. If we look back in our graph, here we have 2011. This is where Standard & Poor's downgraded the US credit rating. As you can see, the downward slide continued until July the next year. So right now it's a pretty interesting risk that we have. Risk scenario, and as we can see, it looks very closely related to the stock market as well. honestly, this whole situation with the government being shut down is also a nuisance to traders like ourselves, because we're looking for economic data, and we have February's non-farm payrolls coming up. This means that if the government is still shut down, we have a higher probability that the credit rating of the country will drop, and also we don't have much of economic data to go on. Now, the Consensus Bureau of the United States, they provide a fraction of the data, but nonetheless they're the ones that process a lot of the data and give official statistics. So we may even skip February's non-farm payrolls due to the fact that the government has been shut down. Now, I wanted to talk about the trade wars in a little bit more detail. Let's take a look at the graph. US dollar, Chinese yuan. So here we have this this downward motion signaling the strength of the Chinese economy. Now, I'm not 100% sure if you've read these news before, but the People's Bank of China injected $83 billion worth of liquidity in the repo markets. Now, for those of you who don't know what the repo market is, basically it's a huge market for the government to give out money, to inject capital in times of crisis. It works simple. So the government gives bonds and takes money from big traders like market funds and different institutional traders, and then the process is very short term, and then gives back the money with interest. So it's basically a liquidity mechanism for world governments, and it's practiced all over the world, like what we see in China. Now, I'll give you an example of how the US Fed uses the same trick. In 2008, when we had the financial crisis, the US Fed pumped so much money into the economy that that it drove the interest rate down to zero, basically, and it had it pretty close to zero from 2008 to 2015. And those years of easy money left so much money sloshed around in the market that the traditional interest rate tools that the Fed had at its disposal no longer worked. So now it wades into the markets daily to let other people borrow money at a higher interest rate than even banks are doing so now. Now, talking about trade wars, these disputes might easily spill over into other countries. Let's take a look at the Japanese economy. The Japanese yen. Now, this was the flash crash of the yen that we had in December. This is going to ruin your graphics or your graphs for a really long time. But the reason that I wanted to show you this graph was that one of the sectors that is affected most by trade wars is the automobile sector. So this is really worth our attention because the Japanese economy is very highly dependent. A big portion of their GDP is used in, is part of the automobile sector. So I think that it's a good idea to pay attention to this. Now, another happy, I guess, thing to talk about today is that the U.S. is going through earnings season, and some of the earnings seasons some of the stocks that recently reported was Goldman Sachs. Now, you can see that they returned to a previous level and with a nice gap. Now, a bank that missed earnings is JP Morgan. They missed sales, but still, if we look at the daily graph, the withdrawal was not, so here we can see that they missed it by 22 cents, or by 10%, and the withdrawal that they had was insignificant. So this is a strong indicator for us that similar financial institutions could be in for a good rebound. As soon as we beat this interest level of 101 to 104, we'll be start looking for longs in these stocks. considering that the whole economy and that the S&P in general, we'll have a look at that graphic again, that the S&P 500 is showing signs of turning around. So we won't be partaking in longs if the whole economy as a whole looks like it's sloping downwards, which currently it does. Now, I would like for you to watch Netflix because they report today. We'll have a look at the economic calendar a little bit later, but Netflix in about 2 hours are going to be reporting. I'm not sure if they're before market open or after market close, but you can have a look at that yourself if you're interested in this security. So Netflix has already beat some local highs and shown good signs of reversal, and today's reporting of earnings should be a very interesting occasion that traders should watch. Now, I want to show you a way that you can create an index yourself using a chart like this. So for those who don't know, Netflix is a part of the Fab 5. They're called FANG stocks, and they have overperformed the market for the last 5 years. So they've been showing higher returns than the S&P as a whole. Now these 5 stocks, that for those that you don't know, so FANG, Facebook, Apple, Amazon, Netflix, and Google. So those are the 5 companies. Tech stocks in general have been the #1 performing asset class since the financial crisis, just so that you know. Now here I'm going to share with you a index that I made about the FANG stocks. So it looks like this. It's a very simple mathematical equation: Facebook plus Apple plus Amazon divided by 10 plus Netflix plus Google divided by 10. All of that summed up and divided by 5, which gives us the average. Now the reason I divide Amazon and Google by 10 is because their stocks are at or over 1,000, whereas the other stocks are below 1,000. So if we take a look at that, so this is the whole index that we drew ourselves. It looks a little bit different than the stock market because when FANG stocks grow, they grow. And this huge pullback that we had since October is quite substantial. So we're looking for a nice bounce here, which we had. And so this is a way that you can create your own index to track different commodities. In a later webinar with me, we'll talk about different ways that you can structure your technical analysis and some filters that you can put on to watch different stocks throughout the day. Now, going back to the S&P, we've had a few noteworthy levels this past quarter. So here we marked them in the beginning of the webinar. And basically this is the neckline of this head and shoulders that we had as a reversal signal for the colossal bull rush of since 2009. So we're back at this neck level here we have, and basically we're waiting for price to choose a direction before we do as traders. That's the rundown. And if we look at other bourses, other stock exchanges, like say the DAX, they show a similar picture. Now this is very indicative of what's going on in the Eurozone. So this is the German stock index. All of the second part of last year, we've been noticing a decline. If we even a better trade situation that we may have a little bit better than the DAX is the FTSE MIB, FT, which is the Italian bourse, the Italian stock exchange. And as you can see, the technical pattern looks a little bit better than what we saw with the DAX. So for those of you who are trading the European bourses, this might be a better situation for you right here. One more thing that I wanted to talk about that kind of ties into the US-China conversation is the Shanghai Composite. So let me pull that up on the screen. So these are all the Chinese stocks on the Shanghai index, the ones that are in the index. And if we draw a trend line here from the top to the bottom, we may have our first breakout, even though today was more of a negative day. we may be looking at our first breakout, but I definitely would not bet money on this. So the last bar that we had yesterday signaled on my charts that that was an interesting position to look at. And lastly, let's look at emerging markets. So they're making a very provocative move upwards. We can draw the same trend line, and this breakout is looking a lot more provocative. But again, we would need some more time to see how the situation plays out with the US stock market, because it takes about 50% of all the world's securities in total, the capitalization of the world stock markets. And lastly, let's have a look at our economic calendar, what happened yesterday. So yesterday, out of the more important and interesting positions, we had crude oil inventories, and they more than doubled the expectations of analysts. What that means is the higher that we have, the higher rise in crude oil inventories, the lower the price. It basically means there's less demand. The higher we have surplus, the less that means we have demand. And that's a bearish sign for oil, which we saw move down yesterday. Now today we're already at the European CPI. The European CPI should come out very soon. So it refreshed my filters too. Now, for those of you that don't know, the bulls that we are indicating right now are volatility. Usually I look only at maximum volatility events. I'm interested in making profit scalping and intraday. So those are the ones that are interesting to me. But here we have Thursday's CPI. Basically, they stay standard. So CPI means Consumer Price Index, and that basically is a basket of goods that people pay, for their daily lives. The higher this number is, that means the more inflation is in the country. This is an indicator of inflation, a very direct indicator. We have Lautenschlager, that's giving a speech today. And building permits in the US are coming out. Now this is an indicator of a very strong indicator, and I'll explain why, of economic activity in the US. Now think about it. When you buy a new house, what kind of other expenditures are associated with that house? You're going to need to get a lot of furniture. You're going to need to get a lot of appliances. So new building permits are a huge driver for the economy, because it's a very complex and very broad use of economic cycles. So we have a huge demand for all sorts of goods, which drives the economy forward and growth in the GDP. So that's why we watch this. And also housing starts, meaning how much actual, so building permits give the right to build. Actual housing starts is when the actual building commences. So that's a very, it's a time indicator. It indicates what time the economic wave will be coming. So I'm going to open the floor to questions now. I'm going to have a look at everything that you guys have written. Why? So we'll start from the top. Here we go. So we have Muhammad Bilal is asking us if Olymp Trade accepts Visa or MasterCard. They do accept debit cards. The MasterCard system is an international payment system. I believe Visa and MasterCard are accepted in most electronic payment systems. Now, Chet P asked why they shut down. I presume that this has to do with the shutdown of the U.S. government. There was a dispute about who should pay for building the wall, and how the financing is going to come, and about building the wall between United States and America. So that was a really interesting and humorous, to me that was humorous, a humorous point in the Trump soap opera, that he was very firm on building an actual physical wall between the United States and Mexico to keep out illegal immigrants. That's like a huge issue on the south of the border in the United States. So a lot of people are against it, a lot of people are for it. They think it'll stop drugs, crime, gang activity. And there was an argument within the government about who should pay for it. So Trump orchestrated the biggest shutdown in history. Like I said, we're going on our 26th day today. So I hope that answered your question, Chi. Now, if there's no more questions, we're going to begin to wind down our webinar. I hope you guys learned something new today. Please come back tomorrow. Every day we have different webinars. My name is Yaroslav Birchenko. I will be analyzing the market, providing you with trade ideas. We're going to be discussing fundamental and technical factors, and we're going to be diving deeper into graphs and having a look at different currencies and commodities and stocks that you guys want to talk about. Here we have a question from Sam. She wants to look at USD JPY again. So I haven't configured my graphs for transmission, but we can have a look at, now this is a huge trend line coming from 2017. Now this type of trade right here was a perfect rebound from a breakout type of point. Here we fell below that 2017 trend line and are now retracting from it as a resistance point. I think it's a good time to wait right now because there's no clear picture. This bar right here, which was the flash crash of the yen, it doesn't give us any information, so I would not be looking for trades in this zone. I would like to see what goes on with the economy. Now, like I said, the Japanese yen is a reserve currency, and it's also a risk mitigator. Anytime there's turmoil on the geopolitical scene, the Swiss franc, the Japanese yen, and gold act as safe havens for your money. So keep that in the back of your head. Anytime there's a crisis or military action, you can be certain that these assets climb a certain percentage. Thank you, Chi. So I hope that answered your question. Today was a very light session because we were getting in the flow of things. We were having some technical difficulties, but you can expect top-notch content from us in the coming period, and I would love to see you guys all with me on our next webinar. So thank you so much for your time, you guys. Good luck trading out there.